The broadcast is now starting. All attendees are in listen-only mode.
Thank you everyone for attending. We're just going to give it a few more minutes, allow everyone to sort of trickle in, all the listeners. We will be starting shortly, I would say in a couple of minutes. Thank you very much. All right, just going to give it another minute and then we'll kick this off.
Okay.
All right, thank you all for joining. I'm Valon Trubb, Content Manager at IBISWorld. You're listening to Are You Ready for the Next Recession? A webinar covering dangerous lending habits to avoid as we brace for a possible economic downturn. Joining us is Dr. Rick Buczynski, who is the executive responsible for IBISWorld's commercial banking, financial, and risk rating practice, and Kenneth Brown, who is the senior vice president and chief credit review officer for CIT Bank. I'm not going to take up too much more of your time because we have a lot of great stuff to listen to today. So I'm going to kick it off to Rick and let him get started with the presentation. Rick?
Thanks very much. And hello, everybody. Appreciate you joining us. I guess we've got close to 600 people on this webinar today. Just a special shout out to Ken Brown from CIT Bank. Ken and I have been collaborating on banking issues for going on 15 years. And trust me, Ken and I are both in our 60s, so we've been through quite a few cycles, so we've got a little bit of experience in this area. Just one real quick rule. We have everybody muted, but just in case, please mute your phone. We'll have a Q&A session at the end. And just a kind of a side note, and I'll refresh this at the end of the webinar, is we've got 2 related white papers you'll be emailed. I'll refer to some of this today, but all of this is free and informational. So let me jump in and have some fun in the deep end of the pool here. We're going to really be talking about the 8 deadly sins of lending. These are things that that you really need to look at both strategically and from a loan by loan perspective in terms of your whole loan origination and risk management functions at your bank. We're not going to make any predictions today. We're not going to make predictions on when the cycle is ending, how close we are to the end of the cycle. We'll leave that for minds greater than ours to figure that out. But one thing that's incredibly important here is that the stuff, the 8 points, the 8 deadly sins that we're going to go through today are always relevant. I'll repeat, always relevant. Good times and bad. They're just weighted more heavily at the end of the cycle or at the beginning of an economic downturn. And a reminder, you probably saw this in some of the announcements. RMA, our partner RMA, is awarding 1 CRC credit for participation in this webinar. So contact your RMA rep and they can probably provide you with further details. But once again, thanks for joining us. All right, let's get into this. Sin number 1, ignoring the attributes of discretionary versus non-discretionary spending. I've got so many clients that are aware of this, so it's one of the key factors, and I actually have quite a few slides on this section. And what we're talking about here are the difference between things like luxury goods or necessities being non-discretionary spending. An economist might call non-discretionary spending normal goods. So there are several examples that I want to bring up just to kind of alert you. In the white paper, we've got dozens and dozens of examples that I can't get into today. Let's start out with healthcare. Hospital services, ambulance services are more necessities, normal goods. They're non-discretionary spending. On the other end of the spectrum, in the healthcare sector, are things like assisted living. Assisted living can be very, very expensive. In downtimes, hospitals, ambulance services fare reasonably well compared with assisted living. Another example here might be sports medicine as more of a luxury good. In terms of foods, grocery stores, restaurants, people continue to eat during downturns. They just don't necessarily go for lobster and steak. Restaurants, for example, a lot of times during a downturn, franchises, places like McDonald's, can hold up reasonably well. People still go out and they still dine during downturns. They just don't go to expensive restaurants. There are several other examples that I'll go through real quickly here. One, maybe the most highly discretionary of all spending, are travel and tourism. Travel and tourism can really be a boom or bust industry. Now, I'm not talking about just about vacations. I'm also talking about business travel. So airlines, all kinds of transportation, expensive hotels, vacation destinations, all of these really get hit extremely hard and recover very slowly after we come out of a recession. Another example is public versus private education. Public schools fare reasonably well, more of a normal or a necessary good versus private education. My son went to private school. I live in the Washington, D.C. area. My son went to private schools. And during the Great Recession, obviously they get money from enrollment, which is really expensive, and also donations. So they actually had expansion plans, and they had lines of credit that they had to hold back on during the Great Recession because their revenue was dropping. So there's another example of discretionary versus non-discretionary spending. And then there's always luxury versus necessities, used versus new autos. New car sales, especially luxury vehicle sales, crashed during the last recession.
That's right, Rick, and that's an excellent point. And that volatility is really what we're here to talk about. Remember, your borrower's volatility of revenue is hard and oftentimes impossible to manage through. And also pay attention to thinning margins. For example, food is generally thought of as a non-discretionary item. However, even though the grocer still makes the sale, if the customer is trading down, say buying whole uncut fruit versus fresh cut fruit, their margin is cut sharply, and that cuts into their ability to repay their loan.
Thanks, Ken. There is another related issue here, non-durable goods versus durable goods. Non-durable goods are things like consumer products, toothpaste, soap, household cleaners, stuff like that. They hold up reasonably well during recessions. But durable goods, those are kind of the big ticket items. They're very vulnerable to recessions, the end of the credit cycle. They have much higher default rates. Performance indicators are not nearly as good as non-durable goods industries. So I'm talking about refrigerators, washers and dryers, high-end electronic goods, stuff like that. Here's an important side issue. Don't forget about latent correlations. I'm talking about, we had this housing crisis over here, if you can see my arrow. Downstream of that, many contractors were hit extremely hard and very quickly. I'm talking about electricians. I'm talking about carpenters. I'm talking about cement areas. I'm talking about roofers. But also, and one thing a lot of people miss is that there's a high correlation between home sales and durable goods. When people move, they tend to upgrade a lot of the appliances. So you have really a food chain here of correlated industries. So when you're looking at durable versus non-durable goods, always keep in mind that there are correlations between these that may reside in different lines of business that you have. Now, it's not necessarily a bad idea to hedge a little bit if you think you're coming to the end of a credit cycle. There's something in economics that are called inferior goods. It's economics 101 stuff. These are goods and services where demand rises when recessions loom. So when incomes go down, demand goes up. So these are countercyclical industries. A couple examples are thrift shops, thrift stores, but also public transportation. I think one of the most interesting things that we really need to look at is sin number 2. This is the perils of small retail trade businesses and the exposures that many, many banks have. You've got a lot, many banks have thousands and thousands of these small businesses. They're located in malls and strip malls. There are a couple of warning signs, or maybe I should call them attributes, and here they are. Obligors that operate in a highly competitive environment, that being they are price takers and not the Walmarts of the world, which are price makers. They have low barriers to entry. Think of an example. A florist has a low barrier to entry vis-a-vis, let's say, opening up a dental practice, which has a high barrier to entry. It's harder to get in. And also be careful with some of these obligors in industries that are living on thin margins. So basically, I guess we're talking about, to a large extent, mom and pop shops. Mom and pop shops do not control the prices of what they sell or what they buy. So they're kind of in the middle. They're in a competitive environment. Now, here's an example that is dear to my heart: liquor stores, borrowers that carry short-term debt to finance their operations. Particularly in a world that we have now of increasing cost of credit. Ken, I know that you have some experience in this area.
Well, I have experience with liquor stores, but also in the financing of liquor stores. So, and this was a topic we discussed at the recent IBISWorld roundtable. Specifically, CIT conducts sensitivity analysis around interest rates to determine the risk of rising credit costs to our borrowers. So think of this. If your borrower has a 5% interest rate and the Fed increases rates by 1%, we already had 2 rate increases in 2018, and there are likely more to come. That is a 20% increase in the amount of interest they need to pay. That's a lot. And for an already leveraged sector, especially the smaller businesses that cannot pass along the higher costs to their customers, this creates a real risk in the ability of your borrower to repay.
You know, and there's another area that I think sometimes we forget, and that is the transition that we're having with a lot of retailers, particularly some of the larger ones. We all know that we have these anchor retailers, the Sears, the Circuit Cities. They're really changing the whole scope of even CRE investment. We have a large mall just north of us here in the Washington D.C. area, where one of the Circuit Cities a few years ago went belly up, and a lot of the other tenants in that mall went under very, very quickly. They weren't just the little boutiques, but there were also some of the restaurants. There's even a mall nearby here that one of the McDonald's actually closed down. So just be aware that there's a lot of risk involved to some of these mom and pop places that might rely on traffic that's drawn in by anchor stores. So look at that when you're trying to assess risk and also the opportunities to lend. Sin number 3, not doing your homework when it comes to the introduction of new technology. We're always reading stuff in the newspaper about exciting new technologies and how rapidly the world is changing. But it can take significant amount of time to figure out what the industry really is all about and what are the lending risks and also the opportunities as well. So don't be seduced by bandwagons. Just because every other bank is trying to do something, that doesn't mean that that's a good thing for you to do. Don't just chase business because all your competitors are chasing it. We see this so often. There's a classic book called The Wisdom of Crowds. I just wonder if this is a wisdom of crowds or the foolishness of following the crowd. So be really, really careful in this area. Here's an example that is dear to a lot of people's hearts because it's fairly recent. It's the dot-com boom bust. There were more losers than winners. I personally know of a banker who's a friend of mine who lent tens of millions of dollars along the Dulles corridor in Washington, D.C., from the city itself out to Dulles International Airport. There were a lot of dot-coms that popped up there. Most of them went under in a very, very short period of time after the bust. Well, interesting enough, my colleague now who was into lending and loan origination before is now in risk management now, given this experience. There are a lot of opportunities that we read about in the newspaper, but the real issue is, does your bank have the institutional knowledge? Do they have the expert judgment to be able to carry out good decisions, to understand what that technology means, and how you evaluate your opportunities and also mitigate your risk in these areas? But there's another interesting area here too, is that technological change is not necessarily limited to just the tech industry. Think about the publishing industry, Newsweek. Think about the likes of Uber and Lyft and how they changed the world in a very short period of time. And of course, think of retail like Toys R Us. I guess you just have to be really careful that you understand this, because these are the so-called disruptive technologies.
As Rick mentioned, he and I are old enough to remember that when we started working, there was no such thing as a fax machine. We still use a telex back then. You could probably find one at the Smithsonian. The fax machine gained popularity and became a mainstream device in every office. But then over the next 30 years or so, better ideas came along. And as you know, no one uses a fax machine any longer. So it's not exactly a crash and burn scenario, but certainly a life cycle phenomenon that many folks missed and were left with collateral that had no value, or for the equipment sellers, they were left with a dwindling customer base.
Speaking of life cycle, that's a good segue to get me to sin number 4, which is forgetting the obvious dangers and opportunities of an industry's life cycle. Basically, there are 4 kind of life cycles, and it's important to understand these so you can understand both a borrower's vulnerability to downside risk, but also it can identify, if you understand these stages of an industry's life cycle, it can lead to some very good lending opportunities. I mean, you have emerging industries which can move in this day of technological change, can move very quickly to growth industries, which take a little bit longer to end up as mature industries, and then there are industries that are in decline. Many of those facing withering deaths. Just a couple of quick examples so you can hang your head on these. Obviously, in the emerging is my .com story again, and you have a question here of hopping on that bandwagon once again. And there's another example not too long ago, a company called Solyndra. I don't know if any of you remember that, but they were producing solar panels in the United States and were being competed against by Chinese imports. Well, in another 1 or 2 webinars, we're going to be talking about trade and some different contexts, so I'll leave that for a future time period. The growth industries in the white papers that hopefully you'll have a chance to read, there's a whole long list of these. They're pretty capital hungry. They're not necessarily always profitable, but they're growing real fast. They need more they need more capital to grow. They need more loans. They're changing very, very quickly. Exciting. This is a lot of good opportunities here. A lot of people kind of shy away from mature industries because they don't grow very fast. But industries that have high margins, even with slow revenue growth, companies like Johnson & Johnson. Oh yeah, Johnson & Johnson produce consumer non-durables. Remember what I said? Consumer non-durables. So mature industries are a good hedge. They survive recessions pretty well. They don't go real fast when the rest of the economy is on a tear, but it's good to have some of these, particularly if you're facing a downturn, some of these in your portfolio. And then you have industries in decline. Industries in decline are, we've been talking about department stores and newspapers for how long? 1 decade, 2 decades, 3 decades, almost 4 decades we've been talking about these. Some can be on life support forever. So these are ones to really, really be careful of having any exposures in. Sin number 5 is I think one of the ones that's missed most often. It's failing to recognize the threat of substitute products or services. This is actually, if you're familiar with Porter's 5 forces, this is actually one of the forces that it's kind of subtle, but really very important. I've just got 2 real quick examples here, and you can read the white paper because I have quite a few more and a little bit more detail in those publications. The simplest example is online sales versus retail shopping. Okay, these are competing ways, substitute ways of delivering goods and services. Another example can be recycled paper versus virgin paper, virgin pulp. This is an interesting example. It's come up a couple of times in my career. In fact, very recently, one of my clients was looking to go into investing, providing a large credit to a company that was in recycled paper. Most of that, by the way, is cardboard. Now, there's a couple things here, and I'm not pretending I'm an expert on this subject, but there's a difference in the quality between the two in terms of the fiber length, and you can look it up in Google if you want to. But what's really interesting is that the prices of recycled paper versus virgin pulp are not necessarily correlated. Right now, when this client of mine was doing a financial evaluation of this prospective client, they noticed the financials look really good because recycled paper at this time happens to be, pretty strong. But you know what? In 2015, that's only 3 years ago, the market collapsed. So there's a lot of volatility involved. So in essence, you've got to be really, really careful. And there's 3 things that you should look for when within this context of substitute products or services. Watch out for when consumers' switching costs are low. I can think of an example that I've just been through, I think 2 weeks ago. I was looking at Comcast versus Verizon. My switching costs were very, very low. There were no switching costs. And then I looked at the second factor there, which is the prices were highly competitive. So I felt like I had some leverage. And then the third factor is the substitute product or services of equal or superior quality. So look out for those attributes when you're thinking about competing products. Does your obligor have other products that can compete against them? And do they follow some of these attributes? Because this adds to their risk profile. Here is, Ken's known me long enough that this is probably my greatest pet peeve, is overlooking one of a banker's greatest fears, its volatility. This is from a paper that we published earlier this year in the RMA Journal, Ken and I. And basically what it is I've got data from the Bureau of Economic Analysis. It's basically value-added data. And we're just going to look at this latest period right here from 1997, this last come to 2015, because there's a couple of cycles here. And so we kind of measured, we measured volatility. Measuring volatility is really important in your decisions on pricing, risk-based pricing, and also setting limits. So even though an industry at any particular point in time, the outlook might look really, really good over the next 18 months, if it's a volatile industry, it can turn like a dime and you can get caught. So I won't spend a lot of time going through this. We all know that the commodity-based industries, those being like agriculture and mining, they've always been very, very high. We also know that utilities are high. Well, utilities buy a lot of coal and gas from the mining industry, plus they can succumb to local regulatory issues at the same time. We all know that construction is highly cyclical and highly volatile. And the financial sector happens to be volatile as well because we invest in these areas. Now, there's a couple of issues here when it comes to educational services and healthcare and social assistance. So be reminded of sin number one and the issue of luxuries versus necessities.
Good point, Rick. And this also goes back to the ability to substitute and move back and forth. So consumers may substitute a product due to poor economic conditions when they just want to spend a little bit less money, or the introduction of even better products. In both circumstances, it creates volatility of earnings. So this is really about how much leverage you can put on any individual company. Highly stable businesses can be leveraged more than businesses that operate in a more volatile environment. The more volatility, the less leverage you can put on that business. So a couple of examples. Think about the oil and gas industry. Sure, they make money over time, but wow, those cycles can kill you. And I've seen them often kill several of our borrowers. And for us bankers, we all know the impact that the Great Recession had on our volatile banking industry and the impact it had on all of us individually as well. Now, conversely, there are highly stable businesses as well. Think about the manufacturer that produces a critical switch used in aircraft. That is a relatively low-cost component, but critical to the final product's safety and reliability. They can be replaced, so there is a limit, but if they keep their quality strong and price reasonable, their customers do not want to switch and run the risk of what could happen with a new supplier.
Thanks, Ken. And I'm going to ask you to chime in on this last one here too, Ken, because I know you've had experience at CIT with this sin, which is underestimating the significance of capital spending cycles. Let me just take a step back and take a look at this chart here below, and then I think it's going to be clear the next couple of slides. That blue line is basically real private non-residential investment. That's inflation adjusted. What that is, that's machinery, that's equipment, that's software, that's training, that's industrial infrastructure. That's the stuff that has a return on investment over a long period of time. It happens to be incredibly volatile. Speaking of volatility, I mean, look at how it goes up and down and up and down and up and down, because the orange line here is growth of gross domestic product. If you look at the recession, so if you think a downturn is coming, these industries collapse. They collapse at roughly 3 times the rate of the decline in GDP. That means, as the title here says, industries related to private investment are hypersensitive to downside risks. Here's a couple other charts, and let me take a minute or so to go through these. We did a study where we looked at some different industry sectors. There's a lot more detail once again in the white papers that you folks will be able to download. So we kind of looked at the correlations basically between capital spending. We used the same kind of data that we used in the previous chart from the Bureau of Economic Analysis. And so we found some of these with a very, very high correlation coefficient. I kind of highlighted in red. There's more detail, as I mentioned, in the white papers. But there's something very interesting, something extremely, I think, interesting here. So let me kind of walk through a theoretical example. Let's say this is your bank or somebody's bank, and let's say that you have exposures. Let's say on the manufacturing side, let's say that you're exposed to, you have a lot of loans in wood products and furniture, and those have high correlations, with capital spending. And let's say we're coming to the end of the cycle. But let's say you have an additional exposure in a different line of business on the wholesale side where you're into furniture and lumber, which also have high correlations. You have a what could be a latent concentration risk to capital spending in several areas in your portfolio, and these really need to be recognized. Ken, I know you have some comments in this context.
Yep. So in addition to what Rick had just discussed, here's an example from my history as a credit officer. So I remember back in the 2000 downturn, we had a lot of construction companies in our portfolio that were stressed, and many of them wanted to sell some of their equipment. Now, this is a little bit different than the capital spending cycle on new equipment, but the dynamics are actually pretty similar. So in this case, many construction companies didn't have a lot of business and wanted to sell their equipment to raise funds, or the bank had foreclosed on the equipment and the bank needed to sell the equipment. The problem was no construction companies had enough business to justify purchasing more equipment. Moreover, no one had sufficient capital to purchase equipment, even if they wanted to buy it. So what happened? Yep, you got it. Prices dropped to the point where only the speculators were the buyers. And a speculator will only buy equipment at a price that's low enough so they can carry it for a few years, and then they expect to make a very meaningful profit from it. So it is a cyclical, very cyclical spending cycle.
And our last sin is disregarding the domino effects of concentration risk. We think this is such an important issue. We're going to have a webinar on November the 14th, which you'll get an announcement. That will be totally talking about concentration risk. It's based on a paper that I wrote a few years ago with a retired senior executive from the Atlanta Fed. Just a kind of a must-read reminder. You'll be getting an email today because we have part one white paper that is the background for this webinar, and then on October the 10th you'll be getting another email where you can download the part two white paper from this webinar. And I have one commercial message, and that's it. I'll be speaking at the annual Risk Management Conference in the Washington, D.C. area in early November. I'll be joined by Dev Strychek. If you're readers of the RMA Journal, he's published more than 200 articles in the journal, and we've actually spoken together and published together before. And the title of our talk will be Alert as the Credit Cycle Grows Old, Opportunities and Challenges for Commercial Lending. With that, I'm running out of steam here. Thanks for joining us, and we have a little bit of time, I believe, Valan, for some questions.
By the way, first of all, thank you very much, both of you. That was a lot of insightful information. I know I'll be spending some time digesting all of it. For some of you, I just wanted to let you know that the presentation will be available to view again, and we'll forward a link as soon as the video is uploaded. As for questions, we did have some interesting ones come in. We all know volatility is important, but how do I prepare for it?
You know, the best thing to do is kind of back test your data, your performance data. I mean, I would look at different lines of business, your performance data, stuff like delinquencies and charge-off. It's probably good to kind of look back over the cycle, so you get a long enough time period. You can do some simple statistics like variance and standard deviation and stuff like that. But you know what? Sometimes a scatter diagram will work, because sometimes pictures can indeed tell us, 1,000 words.
All right, we have another one here. How can we best prepare for concentration risk as we are uncertain when the cycle will end?
Well, tune into our November 14th webinar. But seriously, smaller banks are concentrated, basically by definition, owing to small geographic footprints. So it's important for bankers to work with, in our opinion, the better bankers that I see that are on the smaller side, Work with your bankers so that both you and they understand what the 8 sins of banking are, and discuss them openly. Big banks, it's a little bit more complicated, and I think at the end of the day, it's all about mapping and coding, concentration risk. I mean, these are long-standing issues. A lot of the clients code their stuff given 6-digit NAICS. For starters, some of them use the OCC taxonomy, if you're familiar with that, if you're an OCC bank. But I think what's important for all bankers you try to look at the supply chain of your borrowers. Are you concentrating? If you have a certain class of borrowers, make sure that you understand who their suppliers are and who their end markets are. Ken, did you have something else you wanted to say here?
Yeah, the only thing I would add is that as bankers, we need to constantly be looking for new concentrations. They can be hidden until it's too late to react. So everyone needs to be vigilant and thinking about all the various flavors of concentrations. There's geographic concentrations. There's concentrations in who our sources of business are. There's concentrations in the products that we're selling. There are concentrations related to the collateral that you're financing. It's very easy to kind of forget some of those second and third tier concentrations, but they can come back and bite you as well.
Well, thank you both again, and thank you everyone for listening. We're going to be signing off now.
Okay, thank you everyone. Bye-bye.
Thank you. Thank you.